Hello everybody and welcome back to the channel. Wanted to send you a very exciting video here with a very interesting topic, so let's just jump right in. The name of the article from Financial Times is U.S. Universities Boost Market Risk as Financial Pressures Mount. And the subtitle is Trump Administration Funding Cuts and Weak Private Equity Performance prompt a search for higher endowment returns. So it starts by saying a U.S. university endowment taking a bigger market risks to boost investment returns as schools face growing financial pressure from Trump administration funding cuts and weak private equity performance. So 8 of the top 20 university endowments by assets under management, including Harvard, increased their exposure to tech stocks or cryptocurrency-linked ETFs in the first quarter of this year compared with the end of 2025, according to public filings, despite concerns over stretched valuations and market volatility. The efforts come as Princeton University's endowment this week scrapped its policy of divesting from publicly traded oil and gas companies, marking a retreat from climate-related investment pledge adopted 4 years ago. That's interesting. So they scrap the policy of no longer investing or preventing themselves from investing or selling publicly traded oil and gas companies. So this is basically them, again, a university that had previously had a climate-related investment pledge, which was adopted 4 years ago, but that is no longer the case. So elite university endowments' increased risk appetite underscores the pressure they faced to boost returns as federal funding cuts and private market strains weigh on their finances, leaving them more exposed to market swings. Okay, so there's several factors here why elite university endowments are seeking this increased risk appetite. They have pressure to boost returns. They are getting federal funding cuts, okay, and private markets such as private equity are not giving them the returns that they usually had. So this is leaving them more exposed to market swings. There could be pressure from the endowment board or university administration to take a bit more risk and stretch the returns, said Phil Casey, founder of Institutional LPs, a technology company that works with endowments. But that could come at a cost if there's a market correction. That's right. So the university endowments will be open to more risk, and if there's a market downturn, then that risk can lead to a big correction. So leading universities have faced a growing funding squeeze since last year as the Trump administration froze or canceled billions of dollars in federal research grants. Harvard was hit by a freeze of $2.2 billion in grants and $60 million in contracts after it rejected federal demands, while Princeton said about $200 million worth of grants from agencies, including the Department of Energy and the Department of Defense, had been suspended. Spokespeople for Harvard and Princeton declined to comment. Okay. So endowments are a significant source of funding for universities, accounting for 15.2% of annual operating expenses, according to a 2025 study by the National Association of College and University Business Officers and Common Fund. Okay. So the strain has been compounded by top endowments' heavy exposure to private equity, okay, which are not very liquid, where sluggish exits have slowed distribution to investors. So top quartile global buyout funds reported 8% returns in 2025 compared with 18% for the S&P 500, according to McKinsey. The pressure is reflected in the recent underperformance of the largest endowments, known for their heavy exposure to private equity, compared with smaller peers that rely more heavily on public markets. So endowments with more than $5 billion in assets returned an annualized 7.8% over the 3 years to June 2025, compared to 11.5% for those with less than $50 million, according to the NACUBO Common Fund study. So the University of Texas A&M Investment and Management Company, known as UTIMCO, reported higher holdings in several tech and AI infrastructure-related stocks, including NVIDIA, Cisco, and Ciena in the first quarter. I think if you're going to be overweight somewhere, said Richard Hall, UTIMCO's chief investment officer, in a board meeting in March, being overweight in infrastructure that supports AI is probably not a bad place to be. Okay, so that is a interesting strategy from the chief investment officer of UTIMCO. So a spokesperson for the University of Texas system said its endowments portfolio was diversified across sectors. Thank you. So the University of Chicago also increased holdings of technology-focused exchange-traded funds, ETFs, while cutting its position in an S&P 500 ETF according to public filings. So increased holdings in tech-focused ETFs and make a cut in an S&P 500 ETF, which is maybe a little bit less dynamic. So the university's investment strategy is continuously evaluated and updated, with the university gradually shifting its portfolio based on evolving market opportunities, a spokesperson for the University of Chicago said. Other endowments have turned to digital assets in search of returns, exposing themselves to a highly volatile market. That is true. So Emory University increased its holding in the Grayscale market Bitcoin mini trust ETF to 1.35 million shares in March from 1.02 million shares at the end of last year, while Dartmouth College added a new position in the Bitwise Solana staking ETF. Emory spokesperson declined to comment. So Laura Wyrick, managing principal at Maketa, an investment consultant that works with endowments, said some institutions might view crypto-linked ETFs as a source of portfolio diversification as digital assets become easier to access through regulated investment vehicles. There are more institutionalized ways to gain access to the space now, she said. The early performance of these higher risk assets has diverged sharply. So ExxonMobil has gained about 22% this year, helped by higher oil prices and geopolitical tensions, while the NASDAQ composite is up more than 10% despite a share tumble on Friday and Bitcoin down 30%. Princeton's decision to allow renewed exposure to publicly traded oil and gas companies is another sign of elite endowments reassessing investment constraints adopted during years of abundant capital and stronger political support for climate-conscious investing. Vincent Tuohy, president of the $36 billion Princeton University investment company, said in an announcement on Monday that the move was part of a revised approach designed to give the endowment greater investment flexibility while maintaining its commitment to reaching net zero by 2046. It's not obvious that Princeton's initial approach has moved to the endowment meaningfully closer to net zero, said Tuohy, referring to the endowment's decision in 2022 to liquidate holdings in dozens of publicly traded fossil fuel companies. Nor is it obvious that major energy companies will be out of balance for a net zero endowment. So Tuohy also acknowledged the new approach would give Princo more options at a time when higher education is under financial strain. So self-imposed constraints on our investment strategy can have outsized impacts on our students, faculty, and laboratories, and on future generations of Princetonians, he said. So universities lean on endowments, right? So the investment overhauls coincided with a broader backlash against climate-conscious investing from the Trump administration, which has promoted oil and gas development and sought to remove investment restrictions tied to environmental goals. So Casey said the policy shift carried both political and investment benefits. You can kind of placate the federal government and give an olive branch to Trump, he said. At the same time, Princeton's reversal could give its endowment access to energy stocks that may act as a hedge against inflation and geopolitical shocks, such as the U.S. war on Iran. So Wyrick said exposure to natural resource companies could be beneficial in market environments such as the first quarter, when such assets were the only driver of returns and source of protection in portfolios. So this is a very interesting article for those who are interested in portfolio management, because it's basically saying that a lot of these big endowments, they have so much larger assets that usually the bigger your assets under management, the more conservative you're going to be. So this article was pointing at 7.8% versus 11-12%. So it's really saying that the smaller endowments are more nimble. The smaller endowments have more strategy when it comes to they are taking more risk. So as you have larger endowment funds, they're going to be more conservative. But if you have sort of artificial or rather superfluous guardrails on what you can and cannot invest in, this article was basically saying that several large universities have to basically remove these chains, these sort of racing blinders, or these a bridled blinders. Okay, you cannot necessarily expect your assets to perform optimally if they have these placeholders that are really preventing the maximizing of a portfolio. So I think the article was speaking to several factors, which is that even endowment funds themselves are going to be proactive in reassessing what perimeters they have on their investment thesis, and they're going to just embrace the fact that dynamic equities and companies such as Exxon that are going to survive and thrive actually regardless of recent geopolitical changes and rising price of oil. These stocks are going to be performing quite well, in fact, even though they are not the greenest or the most carbon net zero or carbon neutral or those sorts of things. So this is why I shared this article, and we just read it today, because I think that people need to understand that if you're an endowment, your investment mandate is to maximize the security, but really maximize the returns. Okay, so when you're reading an article like this, people need to understand that there's a lot of options out there for people to or institutions to engage in, but they want several things. They want to have liquid returns. They want to be able to withdraw, and equities offer that, and private equity does not offer that. And they want to have something that is really able to be dynamic in the current market atmosphere. And so what was basically blacklisted is now back on the table, such as energy stocks. So with that being said, thank you very much for today's video. If you've gotten to this far, you can feel free to subscribe and like and all that good stuff. But please, please, if you are involved in banking, if you are involved in fixed income, if you are involved in those sorts of things, please share our YouTube channel, share our link, cryptodeposit.org, so we can expand our partnership base with people in your network, whether it's retail or institutional. Cryptodeposit.org. Plenty of tutorial videos to get started, or simply just email us at info@cryptodeposit.org and we can get you onboarded right away. Once again, have a good day, everybody, and see you on another video very soon. And talk again on another video coming up in a little bit.